2760 here as more optimism about U.S.-China trade and the border, I assume, is driving things. How much do you think the rally we've had since Christmas Eve needs to be digested here, or is this going to create a little more FOMO, having reached that 200-day?
Well, I think we were a little bit overdone to the downside. If you look at investor sentiment at year end, we were at the lowest level of optimism since the financial crisis. So I think that some of this was just a simple bounce back of reality and expectations. You know, that said, we do need to see some progress in these China trade talks. My concern, however, that this tactic, which has turned into a strategy, will likely morph into a policy, and there may be tariffs that are going to be in place indefinitely. And I want to make sure that investors understand and calculate that possibility into their current assessment of the market.
Yeah, and Keith, to that point, that does seem to be one of the key questions here, is are those tariffs immediately going to come off if there is, in fact, some sort of deal that happens? Do they get gradually reduced? Do they go back on? Are we even going to get a deal?
Yeah, I think that's actually an open question, but I think the more important thing is that there's progress being made and there's likely to be a deal sometime over the next several months. Listen, there's a big incentive for the administration to have the economy looking good into the election next year. And I would say that the big thing is, you know, when all these fears that people have been talking about over the last several months, don't forget, a lot of those fears were overdone and they become catalysts. So you had concerns on trade, you've seen some progress. You've had concerns about earnings. We've had a better than expected earnings season. You had concerns about the Fed, and now the word patient is in the vocabulary. So all those things have become catalysts. I would say short term, because of the FOMO and investors are still somewhat underinvested, we could squeeze a bit higher. But we do suspect that we're due for a period of consolidation after a 17% move off the lows.
A couple of data points that are out there. On the one hand, the labor market looks pretty tight. Workers are quitting. On the other hand, we just got this number showing that there are more auto loan defaults than there have been in a really long time. So worker-wise, consumer-wise, are things healthy or not? Should we be looking at positive or negative impact down the line on companies because of these data points?
You know, on just about every metric that I look at on the labor market and household income would suggest happy days are here again. You know, we've had wage growth of 3.2%. We're projecting an additional wage growth of 3% over the coming 4 quarters. And, you know, that's leaving overall inflation in the dust. And yet, you're right, this Fed report on auto delinquency is a head scratcher because it just doesn't seem to add up with all of the other pieces that are falling into place. You know, that said, you know, we're looking at work stoppages. Work stoppages now over the last 12 months have involved over 700,000 people. This does not include the government shutdown. That's the highest level since 1983, when we had very tight labor market and inflation was running near 4%. So that is somewhat of a concern. But, you know, we do have to weigh these auto delinquencies into the consideration.